Hey everyone, welcome to another episode of ADMAIL. This is Adam Bergman, founder and CEO of IRA Financial. I'm here to help you find the answers to the most frequently asked questions from my clients about self-directed retirement accounts. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Hey everyone, and welcome to another episode of ADMAIL. I'm Adam Bergman, tax attorney and founder of IRA Financial. And on today's ADMAIL, I'm going to address three wonderful questions from three clients. And let's just do it. Let's get right into it. It's going to be a fun episode. So if you are interested in solo 401k, self-directed IRAs, opportunity zone projects, sit back, listen up, and think you'll learn something. It's going to be fun next 10 or so minutes. So question one, if I want to set up a solo 401k plan for my wife's business, can I be the trustee of the plan? And this is from Steve Y of Fort Worth, Texas. So Steve, generally in the case of a solo 401k, anyone could serve as a trustee of the plan. Now the trustee is clearly the one that is responsible for plan decisions, the fiduciary of the plan, and the one that has the most power with respect to plan investment. So in most cases with a solo 401k, which is generally a plan for one person or maybe more than one if there's multiple owners, or even a spouse of an owner, because the spouse of an owner is not treated as an employee for ERISA purposes. So you can still have a solo 401k even if you have a spouse who works more than 1,000 hours, that's a non-owner, that works for you. So in most cases, 5% or so, the individual will be the trustee of the plan, right? So Adam Bergman has a Adam Bergman consulting firm. I set up my solo 401k to get my $1 million of income. I want to put away $58,000 because I'm under 50, and I'm going to be the trustee. Even though my wife's 1,000 times smarter than me, I'm still going to be the trustee in most cases because, hey, it's my money. I'll just invest it. But I'd say 10% of the cases, you're going to have a situation where there's a spouse. Generally, this situation only applies to spouses because you're not going to trust some business person or third party with investment decisions, generally over your plan, as well as the ability to have control over the bank account of the plan. So I've seen it. I've been doing this 12 years plus 20 plus as a tax attorney. Very, very rare where you have a business and you're going to have a third party that's not lineal, not a family member, be the trustee of the plan that's not in the business. But it could happen. But in most cases, it's your business, you're the trustee, or let's say your wife's the genius of the business, but maybe the husband is better at investments, or vice versa, right? The husband runs a business, but the wife's the superstar stock picker. So you just rather have the wife be the trustee, make all the decisions. Either way, it's your money. You can do whatever you want. You can have a third party be the trustee, as long as that person agrees. I've seen co-trustees, which makes a lot of sense too. You can have a husband and wife be trustees. Both will have to sign, or you can authorize one to have signatory authority through a resolution. So you have a lot of options. I just think if it's your money, you should have some responsibility. Maybe not to make decisions from an investment standpoint, but generally control over the bank account. And that's why being the trustee is so important, because you'll have control over the day-to-day operations of the plan, which includes the bank account. So I would put yourself on there if you want to add a spouse or a third party to help you make investments. Fine. I mean, you don't have to make them the trustee, right? They can just have the ability to assist you. But if you want that person to have investment discretion, then maybe just do a co-trustee or set up a trading account and give that person authority over that account, but maybe still become the trustee of your plan. So you still have control over other aspects of the plan. So Steve, that's my suggestion. If it's a plan for your wife, then do co-trustees. I think that makes a lot more sense. Second question, Kenny C of Greensboro, North Carolina. And I know Kenny, and he actually asked me this question, but I want to share it with all of you. I have a checkbook IRA LLC with IRA Financial and need to travel to check out property I may want to buy. Can I deduct your travel costs? So the first thing I told Kenny is you don't own the property, Kenny, right? Your IRA does. That's the concept behind a checkbook IRA LLC. The IRA is the owner, you're the manager, but the IRA is the sole owner of the LLC. So you have your LLC in North Carolina, say we called it ABC LLC. The IRA, care of IRA Financial Trust, is the sole owner, so it owns 100% of the IRA. And the LLC operating agreement, Kenny, has you as the manager. So you have control. You can pick the property, you can decide what color the house is, how much you want to pay for it, who you want to rent it out, when you want to sell it. But from a travel standpoint, I would not pay travel fees. As the manager, remember, you're acting on behalf of your IRA. So it gets a little bit, I would say, messy, for lack of a better word. Generally, of course, you can't personally deduct it. It's not a business. And number one, you're not the owner of the business. So a deduction would flow through the business. So that's not an option. Now, could you get reimbursed? Maybe, Kenny, that would be the right question. Could you get reimbursed? And I think it's risky. Why? Because anytime IRA funds are sent to a disqualified person, i.e. you, there's a trail, and it always opens the Pandora box for the IRS to question that transaction. Now, the regulations under 4975-6 say you can be reimbursed for reasonable and necessary expenses. Now, that generally is, a lawyer or paying the IRA custodian or an accounting fee. Going to see a property, I do not think is necessary. You could have had a third party do it. Maybe you can check it out online. You can hire a realtor or someone to do this, take pictures or video for you. So I'm not sure it's necessary. I bought stuff without going to physically inspect the property. It does happen. It's not common, but it happens. Now, if you want to go, Kenny, go fly or go drive, do what you need to do. No one's going to know if you're driving on your own personal time to check out property, just like you may spend 2 hours a day researching stocks for your IRA, right? On company time or on the weekend, whatever. It's something you can do, right? It's your money. You can still make an investment decision for your IRA. I just wouldn't deduct, definitely not, and certainly would not try to get reimbursed for any IRA real estate expense because, again, it opens the window ajar to potential IRS attacks. You're going to have to potentially explain what that expense is. Was it solely for the IRA? You expense the Denny's breakfast. Did you have to eat there? Is that a personal benefit? It opens up the window to attack, and it's just not worth it. So if you got to go to Raleigh or to see the property, just drive there and just take care of it. There's no need to deduct it or get reimbursed. It's a personal travel trip that you happen to check out this property. I think that's cleaner, safer, and will protect you from IRS scrutiny. So that would be my suggestion to Kenny or anyone out there who's looking to travel to see a property that they may potentially buy in their IRA 401k. Just do it. Don't deduct it. Don't reimburse it. Just do what you need to do. Just like if you are stock picking in your IRA or buying cryptos, you may spend time or speak to people or do things like that, but not sure you're going to want to reimburse or take a deduction for that activity. Third question is from Lauren M. of Scarsdale, New York. And Lauren wants to know, can I use my IRA to invest in an opportunity zone project? So you can. And obviously, just to give you some background, what's opportunity zone projects for the listeners out there, just may have not come across that type of investment before. Essentially, something that was created by during the Trump administration period. It was actually bipartisan support. Democrats and Republicans supported this, and its goal is to spur investments into areas of the country that are underdeveloped. And the incentive is, hey, if you hold the property, or I should say, if you hold the investment for at least 10 years, then there's no capital gains. Now, we know retirement accounts don't pay capital gains, right? So you're losing some of that benefit anyways. But if you think it's a great investment, or you just want to do something really good with your retirement account to help out a area of your community, of your state, of your country that you feel could be a successful investment, also help the people, the community that is surrounding that investment, you can do it with an IRA or 401k, even if you sell it in 2 years, you're not going to have to pay any capital gains tax, which is great. The one hurdle is you generally need to be an accredited investor to do operating zone projects. And what is or who is an accredited investor? That's someone who makes at least $200,000 a year, $300,000 if they're married, filed jointly, 2 consecutive years, or have a net worth over $1 million, not including a primary residence, or have some type of investment certification like a series, or if you work at an investment firm. So if you satisfy those criteria and you are an accredited investor, you can do an opportunity zone project. You don't have to wait to 10 years because none of the gains would be subject to tax. If the project did last 10 plus years, then you would receive all the gains without tax anyways, because IRAs or 401ks don't pay tax. So you don't get all the benefits of the opportunity zone, right? Because if you did this with personal funds, you would escape capital gains taxation so long as the investment was held 10 plus years. But hey, if you think you're going to do really well with the opportunity zone, you think it's a good investment, plus it's going to do some good for the particular community at issue, then it may make a lot of sense for you. The only hurdle, again, you're going to have to deal with is the accredited investor threshold, which generally you would need to satisfy to do an opportunity zone project. So, Lauren, I hope you got what you needed on this question. Obviously, thank you, Lauren. Thank you, Kenny. Thank you, Steve, for your amazing questions. 3 great clients of IRA Financial. If anyone has further questions, you can hit us up on Facebook, Twitter, or Instagram, YouTube, IRA Financial, or you can just send us an email to info@IRA Financial and just say ADMAIL or Ask Adam, and those questions will find their way to my inbox. I get maybe 20, 25 a week, so I got a lot in the queue, and I'm just trying to pick the best ones. But if you send a question and it has not been, if I haven't got to it, I'm sorry. I'll get to it. I promise. Just a lot of questions, a lot of people out there in the self-directed retirement nation that are interested in knowledge and are hungry for more knowledge. So I will do my best to get all of you the answers you need. But if there's a question hanging out there that you just can't find an answer for, don't worry. Send us in the question, and I promise at some point I will get to it. So thanks again for listening. If you're watching on YouTube, thank you also. And don't forget to check out my 2 other podcasts, Adam Talks each Wednesday, and Add Bits every Tuesday if you're looking for a bit of information on specific self-directed retirement topics. So there it is. Hope you guys enjoyed ADMAIL, and I'll see everyone again next week.